Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. It was day one of the U.S. government shutdown. Early Wednesday, the Senate failed to pass a bill that would have reopened operations. Meantime, the White House is now planning to swiftly dismiss federal workers. There was also news in the last session of an unexpected drop in U.S. private sector payrolls. According to ADP, a drop of 32,000. So if you look at market action, yields were down across the Treasury curve. Meantime, the equity market finished at record highs. And in a moment or two, we'll look at how the U.S. price action is affecting sentiment in the Asia Pacific. But we begin here in the States. Joining me now is John Pantekidis. He is managing partner at TwinFocus. John joining from Boston. Thank you so much, sir, for making time to chat with me. Are you getting a little nervous right now in terms of the levels that the equity market is trading at?
We are getting nervous given where they're trading at, given valuations. However, we think, given where we think that the Fed will go in terms of interest rates and the U.S. economy is still showing signs that even though it's softening, it's not falling apart. We think that, this has room to go. There's plenty of money on the sidelines, and with the Fed being more accommodative, equities can have definitely room to go here, although we're being very selective in where we put our new money.
So talk to me about that selection process. Where are you finding value in the equity space right now?
Well, we started the year relative to what our peers was doing. We were more equal weight, we'd say, international developed markets and emerging markets. And on the year to date, that's proved to be really a good move. And we continue to be positioned that way. Although in the U.S. markets, we still like large cap growth. We've outweighed that for years, and that continues to do well. We like sectors like utilities, we still like technology. And would still stay away from certain other sectors like healthcare, given the political risks. But that's how we're positioning ourselves within equities, more on the international, given where the dollar's going, given the political tensions and what's going on geopolitically.
So gold reached a new all-time high today during New York trading. I think we got very close to around 3,900. What is that telling you? What do you make of the gold market these days?
What we're seeing, it's interesting you raised that. We've been big believers in gold for the past decade or so. We've been overweight that. What we're seeing is the key difference is if you're looking what's going on with central banks and their reserves, you're seeing central banks decreasing their holdings in dollars and increasing their holdings in gold. And we think that's a key to what's driving prices. And on top of that, you're seeing now different advisors recommending bigger and bigger allocations to gold. It's becoming more mainstream, and that's just feeding the frenzy. And with this continued central market buying, we think that has room to go. We have portfolios probably greater than 5% in gold. Since we've held it for such a long time, the denominator effect, we're starting to trim, but we still like gold here.
So part of that is the Fed story being accommodative, and we've also seen a little bit of easing that's being discounted in the market right now. I think a cumulative 46 basis points in terms of what the swaps market is saying between, let's say, now and the end of the year. How do you think the Fed fits into this story right now? And I guess I'm more interested in whether or not there is a risk here that the market is underestimating, and maybe that has to do with inflation being stubborn or perhaps maybe even moving higher again.
Here's what I would say. We're seeing the jobs market, the employment market is definitely softening, and that's a key thing that the Fed is looking at. We're seeing housing, which is a key component to CPI, that's starting to soften. And the economy is getting weaker. So I think that the Fed, and there's political pressure for the Fed to move lower, and I think that's all going to create a situation where it will move lower. Now, inflation, again, with employment being where it is softening, with housing softening, at least on the shorter term, it should act a little better. Although there's key reasons why over the longer term inflation might be stubbornly high above the Fed 2% target. On the shorter term, I think there is room where the Fed can cut given the inflation outlook.
So, John, you don't think stagflation is an issue then?
At least not yet. We're not seeing it with what the U.S. economy is doing, what the global economy is doing, and with inflation. Inflation still, it's not running rampant. We don't see stagflation being a major concern here, although we are paying attention to that.
So if you've been a little concerned about valuations in the equity market and you're beginning to get, I don't want to say defensive, but cautionary, and I'm wondering whether or not the bond market represents any opportunity for you.
The bond market is a funny place, given where yields are, given the current geopolitical situation, and what's happening with treasuries. Is China buying our treasuries? Aren't they buying our treasuries? What impact will that have over the long run? We're being very cautious in terms of bonds. We still like, for our clients who tend to be ultra high net worth families, we still like municipals here, but we tend to be higher investment grade, and we tend to be shorter on the curve, probably between the 3 to 10 year. So we're picking our spots. Are we going crazy with our global fixed income allocations? No, we've liked some emerging markets bond exposure for the FX exposure, and it was a relative trade. It's done really well. Spreads have compressed. Would we add to that trade here? Probably not. But we're being very cautious on the fixed income as well.
What about opportunities offshore? Where are you finding value these days?
Again, we've liked, relative to the U.S., both developed and emerging markets especially, and especially Asia, let's call it Asia ex-China, what's going on with China and the trade situation. We're seeing the rerouting of trade. We're seeing the rerouting of supply chains, and that's benefiting all the smaller companies surrounding China, and that's where we're probably seeing opportunity. I mean, over the past 5 years, U.S. markets have doubled. EM markets are barely, they're up about 40%. So there's a way to go on a relative basis for those markets, and that's where we're probably seeing some opportunities.
So what is the strategy? Is it an ETF play that you look at?
Mainly ETF. On the global equities, we think those markets are very efficient. So we played on, and we like to get low cost, tax efficient exposure, and the ETF is probably the best vehicle for that.
You talked about things that you might be inclined to lighten up on right now, and I'm curious about areas of the market that you think may have peaked, and if you needed to raise a little bit of cash or you needed to kind of look at reducing risk, what areas of the market right now are kind of flashing caution and may prompt you to kind of reduce your exposure?
I wouldn't say flashing caution. I would just say flashing because we've been overweight large cap growth. It's become, from the denominator effect, a big part of our portfolio. We're just taking profits. We still like it, but we're lightening up there. We're using that as a source to raise cash where need be.
John, we'll leave it there. Thank you so much for joining us. John Pantekidis, managing partner at TwinFocus, joining from Boston here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Equity markets in the Asia Pacific are trading higher. This is after records for U.S. stocks. And in South Korea, memory chip makers Samsung and SK Hynix are rallying. This on news the companies will supply chips to OpenAI's Stargate project. Joining me now from Singapore is Ritesh Ganeriwal. He is head of investment and advisory at Syfe. Ritesh, thank you so much for taking time to chat with me. A lot of strength today in information tech. In the States, earlier we had the Nasdaq 100 finishing at an all-time high. I mentioned a moment ago the South Korean chip story. We know that the theme of AI has been a big driver of the price action. Are you feeling confident about this trade still? Does it have legs to continue?
It does seem so, Doug. It's very interesting. You see more bad data and the market can't catch a breath. It keeps rallying further higher and higher. And the AI story, the amount of investments that's going into the space just continues rolling as well. And the latest that you see is the partnership with, of OpenAI with SK Hynix as well as Samsung. So that's definitely, again, propping up these companies at multi-year highs, as you see right now. But even last week, you saw, partnership between NVIDIA and OpenAI. What's really interesting here is the entanglement of investments that is happening, and it's becoming more and more murky as to how the picture evolves as we move forward and what the applications of these would be in the year to come. But interestingly enough, if you think about NVIDIA, they invest into CoreWeave, and CoreWeave, is this data center manufacturer. And that data center capacity is then made available to OpenAI. So they have feeding their own customers in a certain way. And this is interesting because, for now, the story seems to hold. What will be interesting, of course, is how that pans out in terms of actual implications on the application side as we move forward.
I'm curious to get your take on the NVIDIA story as it relates to the Chinese market, because we know that Huawei has been doing very well in terms of its development, and Beijing is actually preferring Huawei over NVIDIA when it comes to providing those chips for a lot of the AI companies on the mainland. Do you think this represents a major threat for NVIDIA?
Not really in a global context. I think China is moving more towards self-sufficiency at this stage, given the kind of curbs that they have to deal with. And that is actually benefiting the local ecosystem. And you've seen Alibaba also coming in and committing more than $50 billion of investments into the AI space. Alibaba is up more than 100% this year. So you're seeing that surge, a little bit of a late surge, I would say, coming into the Chinese stock market as well. It started with the DeepSeek moment, but I guess we've now had the Alibaba moment, and we will continue to see more such news items coming in from China.
It's also been a pretty amazing run for the market in Hong Kong. I think the Hang Seng is up about 30% so far this year. Is that something you expect will continue?
Absolutely. I think, again, from a data standpoint, things are still weak within China. But this is more of an expectations-based rally, right? There is renewed expectations that because data is weak, there will be more policy stimulus that is going to kick in. And we have the 15th five-year plan upcoming as well. Plus, I think some of the measures that have been taken, this is the Golden Week, you're seeing a surge in the number of interregional trips. There is a lot of positive sentiment coming in on the consumer and the spending side of things as well. CPI is starting to look a little bit better at 0.9% and all. And from a policy standpoint, I think so far, most of the policy stimulus has been exhausted. So investors are really looking forward to what's next to come from a policy standpoint as we move forward. The whole anti-involution aspects of it in terms of focusing on quality and really on the demand side, helping with the consumer sentiment. I think that is going to be the key drivers as we move forward as well. But I think most of the rally, if you see, has been driven a little bit more through the retail participation. So that's very interesting because compared to the US market, the participation of the retail segment in the China markets have been much more pronounced. And I guess a little bit of FOMO, a little bit of the policy expectations as well. But I do see this equity rally continuing on expectations of more policy stimulus coming in.
So I'm glad you mentioned the retail trade there, because we are now in the Golden Week holiday, and I want to get your take on what you're expecting to see in terms of performance among Chinese consumers. Will they come out and spend fiercely?
Look, I think what I read is the interregional trips are expected to rise to 2.4 billion. So that's 4%, not big, but in the context of the higher bar, that's still a major uptick that we are seeing. And even in terms of total trips outside of mainland China, that's also doubling year on year as well. So there is definitely positivity that is starting to show up in the market. And as I said, while the consumer sentiment has been weak so far, and there is this deflationary trend out there, core CPI is now at a more stable, 0.9% as well. So overall, I guess when it comes to the Chinese consumer, it is really the story of how do you convert the savings into spendings. And on that front, I think investors are just under allocated into the Chinese equity market, both locally as well as globally. And the reality is there are not too many options because interest rates are low, bank returns are low, property market is not that attractive. Where do you go? So from that perspective, I do see that momentum continuing going forward as well.
I'd like to get your take on trade relations between the U.S. and China. I know this could be a very long conversation on that topic alone. Today, we had word that President Trump is intending to confront Chinese President Xi over Beijing's refusal to purchase American soybeans. Now, apparently, Trump is under pressure from Republican lawmakers from agricultural states in the U.S. to break this impasse. We know that China has been diversifying away from the United States when it comes to certain agricultural products, and I'm thinking of a country like Brazil in particular, perhaps secondarily Argentina. Do you think there's going to be a lot more tension that has to be kind of confronted here before we see some type of trade agreement between the U.S. and China worked out?
I guess, in fact, I do see, U.S. feeling the pinch at this point of time to the extent that, on the agricultural sector, on the AI, stand, there is great guns blowing. But I think on the agricultural side, as you mentioned, there is problems, and these are problems on the ground to the common man. So that definitely means, in my opinion, that instead of being more confrontational, at the end of the day, Trump will have to have an agreement sooner than later with their Chinese counterparts.
So whether we're looking at the equity market in the U.S. at record highs, or whether we're talking about near records for markets in Asia, whether it's Hong Kong or even South Korea, are you a little concerned right now? Are you apt to become perhaps a little defensive?
I think this begs the question of how you're allocating your money. And, at Syfe, again, from an investor standpoint, what we have been observing is clients are hedging. Number one, they still want the US growth story. So they're, investing into the US market still, but they're hedging their exposures in terms of, the dollar weakness that you're observing. And that's a bigger story, in my opinion, because as the dollar weakens, the emerging markets start to become much more attractive as a region. And that's where we have also observed investors, shifting allocations away from the US and into the emerging markets. Some of our, China portfolios the AUMs have doubled in the course of this year. And so these are some of the aspects that we believe will continue to happen as we move forward, where US dollar-based exposure and into the US market itself, that over concentration will get paired out as we move forward. And even in terms of other asset classes, we are seeing more domestic companies and investment opportunities panning out, especially in Singapore, for example. The REITs market has been on the uptrend as soon as we hear the story of the Fed cutting through the end of this year and as well as next year, plus the banking stocks as well. So with the narrowing rate differentials between the US dollar, US interest rates and the other markets, that story will continue to evolve as we move forward as well.
What about other areas of Asia? I'm thinking in particular of India. What do you think of that market these days?
I think it's an interesting juncture. Right now, obviously, there is a lot of tensions with respect to the Indian market, again, being bogged down a little bit with the tension between US and India. And you've seen that pan out in terms of the tariffs being imposed, in terms of the H-1B visa issues as well, and then now into other territories as well. But I think the domestic consumption story and the demographic dividend story of India is still very, very intact. In fact, the number of IPOs that are happening out there, the kind of wealth that is getting created. Now I hear that every 30 minutes there is a millionaire getting created in India. So from all of those aspects, I think the, positioning could be more from a standpoint that there's an opportunity for you to come in, because the Indian market has been stagnant over the last 1.5 years. So if you do want to take that position, this might be a great opportunity for you to come in. And there is also this fungibility of capital, because we had a juncture a year or so back where there was this EM allocation ex-China that was panning out as a theme. So money was pouring into India, and now as China comes back, some of that money is going back into the Chinese side. But from a longer term story, I think, there's definitely an opportunity to, pick on the growth story, that is secular growth story that's still intact within India.
All right. Ritesh, we'll leave it there. Thank you so much. Ritesh Ganeriwal is Head of Investment and Advisory at Syfe, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.